Hello, and welcome to Your Business, Your Wealth. My name is Paul Adams, and I don't have a chance to get this wrong because we're live streaming. As always, joined by Corey, the nicest man you've ever met, if you have a chance to meet him. But you'll never have the chance because he meets everybody by Zoom. Corey Shepard.
When we're live, I notice your voice is deeper. And I think I don't know if it's the sound. I think it's a sound interface for when we're live. It must filter it down even more.
Scientists said it couldn't have gotten any deeper. Well, we got we've got a little bit of a fun conversation today where we're going to talk about a financial tool, like many financial tools that were designed by big box financial retail to be used a certain way. And there are ways that you can use it that are far more effective. And we're going to go through that point by point today in how to use a health savings account if you have a high deductible health plan. Now, for some of you, you may have already done your open enrollment. You may already have made your selections for the new year and you don't have a high deductible health plan. Do not tune out from this episode. The reason we don't want you to tune out is these are going to recur. And it would be our hope that as HSAs continue to gain a tremendous amount of steam over time, that we're going to see further and further expansion of this program, allowing you to better be able to use your money your way. But before we
listen, so you can put that asterisk in your head for the next time it flies in front of your face, like the next open enrollment. We're like, oh, is that my chance now? Yes.
You can come right back to this episode if you're like, I remember they said I should do something, and then come back to this episode and take advantage of it. But before we do that, Corey, this week in planning, we get a chance to periodically see something in the news that we think is of interest or note that could have a fun conversation about what people are doing with their money. And this one is maybe one of my favorites, mainly because of the visual. So let me get this shared with our audience, Corey.
Such a great picture.
It is a really great picture. Hang on. Clicked, and everyone should see it now. We have this person who began buying Tesla. He works for Amazon, is what the article says later. He's retiring at 39 years old with 12 millions worth. Millions? It's a lot of millions.
It's a lot of millions.
But he refuses to sell a single share. I had to say that slowly. She sells Tesla shares by the seashore. So here we go. He began buying Tesla at just $750. Now he's retiring at 39 years old with 12 million worth. He still refuses to sell a single share. Now, I love the picture because even Elon Musk, now of course, this is something where he was on stage and somebody said something he didn't agree with. But I think that even Elon might go, I don't know that I would do that.
Well, I don't know. It'd be curious if Elon has an equal percentage of his wealth in Tesla, like comparatively speaking as this guy. But even if he did, let's go with Elon has most of his wealth in Tesla. Who knows? He's put a lot of money into a lot of things. So that might be his Tesla holdings might be his biggest pot. He can actually do things to change the value of the price and add value to the company. This fella is just buying a thing that he has no control over whatsoever. And that's a huge, huge difference.
Well, and let me let out of the box a little bit, not the conspiracy theory, but maybe.
But the second someone says not a conspiracy theory.
But maybe.
Maybe.
I'm acknowledging maybe. Think about how unoften you actually hear these stories that a person took their earnings, purchased a tech or high growth stock, and now has millions and millions of dollars worth. The reason you don't hear that very often, but you think that you do, and I'll explain why you think you maybe hear that more often than you do. Because most of the time we're seeing these, we see them from the early employees of these large tech companies. Now, there's a big difference in somebody taking their hard-earned dollars where they took risk in the marketplace, in their career, or in their business, and then redeployed it into a very concentrated position in somebody else's business. That's very different than I'm working somewhere. I get a tremendous amount of stock grants and options as a part of my compensation package, which, by the way, that's how Elon Musk got a ton of his Tesla wealth. It wasn't just in being the initial owner, but in the overwhelming amount of stock rewards he's continued to receive as leading this company. Now, this guy is changing the world. We may look back at him in another 30, 40 years, and maybe we're going to be talking about him like we did the changes that Einstein handed the world.
But I mean, Ford is releasing an electric Mustang SUV this year. Never mind that it's an SUV that they're calling a Mustang, but Ford is releasing this electric car because of this guy, because of what Elon was doing, only because of the pressure he's putting on the market.
Massive disruption. So when you read most of these articles are from early employees, and it's all these stories about the wealth that they've created. Haven't you ever wondered why it is there's all these stories about all the wealth of these early employees? It's because these tech companies depend on those stock grants and compensation packages to hire the smartest 20 and 30-year-olds fresh out of school, the experienced 40-something-year-olds that have never seen a huge exit, get them to work 70-plus hours a week, live, eat, breathe, die, and bleed for these companies at relatively low wages compared to what else is in the marketplace because they're waiting for this lottery winning. And the tech companies do everything that they can to push these stories out because what does it do to us as consumers? It makes us feel like, man, if we just get in one of these, we will be that person. But for every person that's like this, they're just like, heck, Powerball, what's the other one? Mega Millions? Yep. Like conceivably, you, if you bought tickets, could win both of them this week, totaling like $1.2 billion in cash payouts, okay? Now, when they get a chance, when people want their identity disclosed, then they say all kinds of things about this lottery winner. Why? Because they want you to see that it would be possible for you, but what they don't do is show you all the people who didn't win, even though intellectually we know that there's a truckload of people that don't win. And in this case, we have this story of this guy, and we won't go into it in deep detail because this is just our This Week in Planning segment, but consider how many people maybe just lost their tails in Tesla because they invested at a high, sold at a low, or all of the other companies that wanted to be Tesla, like Fisker is one of the first ones that pop in my head. Right. It was one of the earliest kind of long drive hybrids that also gave you the ability to have a really clean looking sports car. They're gone. How many of those companies had to go by the wayside to be lucky enough to have landed in Tesla? 1, 2, to have held this long. And 3, Corey and I would like to offer a little bit of advice for this 39-year-old. And here's what it is. Let's say Tesla becomes and continues to be this world-changing company. And that this $12 million grows to be, I'll be ridiculous, like 120 million. It just goes another 10x, okay?
Nuts. Yeah.
Just nuts. And it's amazing. And this guy is crushing it. You see, anytime a stock or a portfolio that we invest in has the ability to go up really, really fast, that's an indicator of its volatility. Now, people say they don't like volatility, and that's a load of garbage because we all love it as long as the volatility is upward. But that also gives you an indication of what those securities could have done on the other side, and nobody talks about that because they're indicating their volatility.
This reminds me of a story we tell about in our new book, Your Business, Your Wealth, about a billionaire who waved at zero going by on the way down.
Indeed.
And how, interviewed later, it would have been so easy for him to just pull 50 million off to the side and have a little safety net.
Never have to worry about it again. Yes.
You can never have so much that you can't lose everything. Ooh.
Hey, you can never have so much that you couldn't lose everything. That's brilliant. I think we should stop. Wait, just scrap the episode today, Corey. Let's just say that 15 more times.
HSA is next time. Yeah.
So for this person, let's say that you just want to secure your sufficiency. And what you did was carve off $4 million. Okay, you just carve off $4 million of that. You put that in an academically allocated, globally diversified portfolio and secure some of that sufficiency. Now, let's look forward. What would happen if the stock does go these 10x from where it is now and you grow to 120 million? Like, oh, now you only grow to 80 million. Now, here's the thing. The difference between, and this is why we want to have accurate thinking with our money. We want to be able to look forward and just have a reasonable conversation about what outcomes are most important to us. So if he's able to set aside $4 million and Tesla goes to 80 million, do you think you notice a big difference in your lifestyle in the difference between 80 million and 120 million? No, I don't think so either. Like, I think you're pretty, like, maybe you go, oh, I'd love to get the $20 million yacht, but I'm on a budget. I can only get a $12 million yacht. That would be the kind of conversation you would have to have, but you would never be totally wiped out. And let's look at the other end. What if Tesla became one of the many companies that are amazing innovators, make a tremendous difference for the world, but don't make the iterative changes required to be a long-lasting, top-of-the-heap company for the next 100 years? And that's much more likely to occur with any company than it is that they're going to continue to skyrocket the way that Tesla has. So this person could set some money aside, secure their sufficiency. If it goes to the moon, they still have all the money going to the moon, but they also make sure they never lose their home. They make sure they never have to go back to work. Now they continue to work because they want to, and they've secured their financial independence rather than just continuing to let it ride on Tesla ad infinitum. Because somebody who's made this big of a statement, there are articles written nationwide about this person. Now, what does that do to you mentally? That idea of commitment and consistency where you keep acting in a certain direction? Like, what's the likelihood that it would make sense to them to then take some chips off the table when it's 25 million, when it's 40 million? Because not only were they quote unquote right in retrospect, but then you've also made all of these public declarations, not just to your friends and family, but also to the world because of some of these articles.
Yeah.
Very, very unlikely that it goes to 120 million. But even if it did, he could secure his sufficiency and still have 80 million at the end of the day. So that is this week in news, this week in planning, and a little bit of news. So let's get back to this idea of the HSA and how you can use it to secure more triple tax-free income well out into your future. You see, what many people do when they get an HSA is they take money because they have a high deductible health savings plan, which Corey's going to go more into in a moment. And then you can open this health savings account and put money into it on a tax deductible basis. Now, what many people do, and what every financial institution is happy to do, is give you a debit card that you can swipe at the pharmacy, that you can swipe at your doctor, or you could just pay your medical bills with any old credit card and ask for reimbursement tax-free from your HSA. That's the way they want us to use these accounts. But here's the question.
And they have the nice debit card, the cool looking HSA debit card. So you're like, oh, I'm at CVS. Yep. Swipe, swipe, swipe. And if you put a little Dr. Pepper in there, they're probably not going to notice, and maybe it goes down. No, they actually are really good at flagging it on those receipts for what's HSA eligible. So don't try that one. Just want to get that out in advance. You're not going to get away with it.
I say try to buy a Dr. Pepper. So But all these financial tools are designed by a financial institution somewhere else, and we by default just use those tools the way they told us would be the best way to use it. And we're going to offer a different interpretation today. But before we do that, Corey, could you take a few minutes, just go through the basics of HSA for anybody who's curious or has had long-lasting questions about it?
And this is important because a lot of folks have heard that term, but I don't think there's common knowledge about what it actually means. And this is why I know this. Try to type HSA into any of your word processors online, on your computer, or otherwise, and it flips it into capital HAS every flipping time. I'm trying to tell clients about HSAs and type on the screen and I can't. So it's not common knowledge yet.
I've even had meetings with high-level Microsoft people as clients, and even they're like, "Yeah, we have the same problem." Like, what? Like, you guys have that problem. Why can't you just fix it for all of us, please? They're like, "We don't know where that is."
Just go in right now.
We're not even sure. Microsoft's so big, we don't even know what department that guy's in.
There's someone there just messing with us. He just has this little office. It's like Office Space, the guy with the stapler.
Yes.
Or something. He's just down there like, oh, I was HSAs. So number one, to be able to open one of these accounts and put money into it, you have to have a high deductible health plan. So that's a health insurance policy that has at minimum a $2,800 deductible as of 2020. I don't know what the 2021 changed yet, but it probably didn't change that much. Now, many of them are going to be higher, and the higher the deductible, the lower your premium. We see a lot of folks with higher deductibles in the $5,000 or $7,000 range. Now, you put money into the HSA pre-tax, similar to an IRA. 2021, the limit's $3,600 for an individual or $7,200 if you're on a family plan. That money grows tax deferred like a IRA or a 401k. This is where the similarities stop, because pre-65, not 59 and a half like the other IRA or 401k accounts, pre-65, you can take out money for medical expenses with no tax and no penalty. There is a 20% penalty for non-medical use, which is
don't skip over that.
The 10%.
The Dr. Pepper has a 20% penalty. if you take the money out to buy the Dr. Pepper, there's a 20% penalty on that. So not the 10% penalty of our IRAs, but 20 plus taxes.
And what's curious is it used to be 10%, just like all the other tax deferred accounts, but the Affordable Care Act increased that to 20% to help pay for the financials of the Affordable Care Act bill. So just a curious thing about how all those different things intersect and come together. So post 65, again, not 59 and a half like the other accounts, you can take the money out for any reason and just pay the tax on it, or it's still tax free for medical reasons. You can pay long-term care insurance premiums from an HSA.
That
you
are
can
in part
pay Medicare premiums. Yeah, in part.
Yeah. You can pay
Medicare premiums, but not supplements. You can't pay for supplements or Medigap policies, but the Medicare Part B. And then the deadline for contributions is April 15th for the year before. So April 15th, 2021 to get all of your 2020 in, or when you file taxes. So that's the basic framework.
The basic framework. And you could see why most people would say, I put in my 7,200 and I just pull the money right back out. I was even guilty of that. I remember one year I had 2020 medical bills because I had gotten that Invisalign type stuff. I think we used ClearCorrect or whatever my dentist used. Straightened out my teeth. Paid for all of that from my HSA. I didn't have any money in my HSA at that moment. So what I did when the bills were due, I went and contributed to my HSA, paid the bill, and then immediately requested reimbursement from my HSA, which made all of those dental things tax deductible in effect. Now, we brought in Jeff Miller.
Which feels really good in that moment.
Yes, no question. No question.
Right. Yeah.
So Jeff Miller joined our firm about 3 years ago. You guys have heard from him on Meet a Millionaire Next Door. And this is a gentleman who had built his financial life in a way that he was at financial independence. Just he and his wife didn't know that until they became clients to really realize that they could stop working and they could be over the line in capital at work to never have to worry about working again. And yet they both continue to do so because they love the work that they do. Now, I was explaining the use of the HSA to clients, and it took Jeff about 6 months. And this is the problem. Sometimes the more you know about money, the harder it is to learn a new strategy with an existing financial tool, including us. Yeah. So it took about 6 months of him just saying, Paul, I think there's a better way. I think that, and he finally drew it out for me. And that's what we're going to lay out today. You see, there's a difference between using your HSA to pay medical bills and using your HSA to reimburse you for medical bills. Now, because so many people relate to it the first way, to pay my medical bills is why they miss out on this opportunity. But there's also this reimbursement component. Now, why is that important? I just told the story about how I contributed and was reimbursed in the following year for my 2020, or not, that wasn't 2020, that was 2018, I think, were those medical bills. But we don't have to take the reimbursement now. You see, what they did in the code is all they said is, as long as the year you had the medical expense, you also had a high deductible health plan, you can request reimbursement for medical expenses during that year with there's no timer on that. Meaning you could make a contribution to your HSA today at 35. You put $7,200 in. And you also have $7,200 in medical bills of all forms. Now, to speak to what Corey said, that means things that wouldn't normally be paid for by health insurance, things like maybe certain chiropractor visits, extra naturopath blood work, dental expenses, prescriptions from the pharmacy, massage, all that stuff falls under
Band-Aids.
This HSA reimbursement. Yeah. Band-Aids. And with little kids, we go through a ton of those.
I'm going to have a kid soon. Yeah.
Yeah, I know.
The princess ones only.
Mm-hmm. Yeah. Yep. And those are just for Corey. We'll see what his daughter wants. So if we,
right,
if
that's
we
what
have
I mean.
those,
yeah, they're not for her. They're for me.
So if we have these HSA expenses, we could wait 2 years, 5 years, 10 years, 15 years, 20 years to be reimbursed. So think about this. We think about certain kinds of financial tools, like a Roth IRA, non-tax deductible on the front end. After tax, it goes in, but we get the benefit of it growing tax-free and take it out tax-free. An IRA, we get to deduct when it goes in, then it grows tax deferred, but we have to pay all the taxes later. We delayed both the tax and the calculation of the tax. This is the magic of the HSA. The health savings account itself. We get to tax deduct it when it goes in. It grows with no taxes on it, and we can distribute the money out tax-free. Show me another tool that can do that. Under the current tax code where you're not breaking any rules.
This is a big miss. We really should have had that wrestler Triple H, like a picture of him, and then redone with triple tax free or something. I'm sorry, everybody.
Triple H tax free. When we post that clip, Jordan, let's make sure we get Triple H in there. Hey, we could probably have him on the podcast. I don't think he's up to much.
Oh, Jordan.
so if we have this triple tax free, go ahead, Corey.
Yeah. Well, I think the thing you said that's just blows it all open, I think Jeff is one who said it, is that the year that you had the expense is not the year that you need to ask to be reimbursed for that expense.
That's right.
And it's something like, 20 years from now, you need $10,000 for something. You just go find $10,000 worth of receipts to generate that tax-free withdrawal. And then maybe you don't spend all of it, because what we calculated, if you started doing the Family Max now for 30 years, never took any money out and got 8% a year, you'd have something like almost $900,000 in there.
Yep.
You probably didn't have $900,000 worth of healthcare expenses over the last 30 years. But as you get older, those are going to come back around and go up by a lot. So you have plenty of tax-free reasons to want to spend money on healthcare on down the line. And so you've been able to compound this whole time. Now,
and here's the beauty. After age 65, say you're in retirement, remember, to be reimbursed for old expenses, you need to have a high deductible healthcare plan in that year. But if you're just paying your regular medical bills in your old age, which I think on average is estimated to be about $250,000 for your average retiree under current medical costs, which are not currently going down.
Yeah.
Then you
not
can,
annual, but over their
yes,
life, right?
Over their life. And so that gives us the ability to really use all of that money tax-free. Now, here's, we're going to get to the mechanics of this in a second, but just really quick, this is kind of about the stage. People are like, wow, this is really good. And you guys are saying something that I didn't realize was the case. If you are thinking that we're teaching some things here that could be valuable to you, reach out to us. You can reach out to us on any of the social platforms, LinkedIn, YouTube, Facebook, or just email us info@sfgway, that's Sound Financial Group way.com. And we'd be happy to come alongside you, see if any of this works for you, and really find out whether or not it would even make sense to work with a firm like ours. But with that,
Jordan's got a link. Jordan's got a link in the show notes where you can schedule a 15-minute call with someone on our team as well. So
if you don't
Paul,
want to talk to us, if you don't want to talk to us, like, subscribe, share, fine. You're getting all this information for free. The least everybody could do. Subscribe to this sucker, because otherwise there's a box of kittens in my basement. I'm not sure what's going to happen to them if you don't. Corey?
I was going to say, you are one of the best I've ever seen at having a strategy for organizing information. You're the original Evernote ninja, and you've got some great strategies for folks like, how am I going to keep track of all these receipts and all these things? Please share, Sensei. This
is about the easiest thing in the world to do, because that's the next thing when we explain the strategy. Like, how am I supposed to track my medical bills from 20 years ago? Technology has made this so easy. You no longer have to have file folders with each year where you've stuffed your receipts. When you finish at the doctor, they're always giving you a printout, or they send you something in the mail after. All you need to do is one of two things. Just get a free Evernote account, or, many people use Dropbox or any of these other tools. All you do is just create a file folder for medical expenses, and underneath that, just put each year. Take snaps right from your phone. You don't need paper receipts for this. Just snap it right from your phone's camera, drop it in that folder, and you never have to think about it again. It's like one little tiny habit to build that could mean, Corey mentioned, that's $7,200. We got a question in the chat. What qualifies for max contribution? Husband-wife counts as a family. You don't even need to have children to have the $7,200 max. So you could put away $7,200 a year if you earned an 8% rate of return, which you could, because you could just throttle on being the most aggressive portfolio you want, because it's going to be 30 years and beyond. And then the thing I think about, Corey, would be, well, let's say I just want the money earlier. You're going to buy a family cabin. It's like, where can I find $400,000? Oh, there it is. Mainly because I have 3 kids, one of which, named Reagan, is not the most cautious, probably going to reach the max on her more than once over the years. And so what we're going to have the ability.
What you're saying is, I want to buy a cabin, so first I'm going to get Reagan rollerblades. That's what you're saying.
Funny enough, they are taking a big interest in hockey right now, and maybe that's the key to my cabin. So if what we could do is just organize all those medical bills, then all we need to do when we want to deploy the money, we can take it out. Now, this goes back, and this might be a good way for us to sort of land the conversation today. Oh, I totally forgot to tell people. After you get just a little bit of cash in most of these HSA accounts, they will give you the option to build a portfolio. So you can be invested in the market with your HSA that entire time. It doesn't just have to sit in cash, although everybody proposes initially it'll be from HSA Bank or Optum Bank or whatever it is, and they don't exactly push the information to you that you could invest that money. They're perfectly happy to be like a regular bank giving you low interest, and then they make their money on the back end in the way they redeploy our capital. So in this case, we take control of that. Not we, Sound Financial Group, we as the consumer take control of that, and you can invest it there. We don't invest HSAs, but we guide our clients on how best to deploy the capital that's in them. Okay. So you now have the ability, as a result of this episode, to have an account that you can deduct the contributions, that you can grow with no taxes on it, that you can take out some of the money way before retirement age as long as you have reimbursable expenses saved from prior years. And I don't want to forget this because Jeff will call me out on it if I don't, is that many of you actually get a summary every year from your health insurance company of all the bills you paid and all the bills they paid. If you get that, take a snap of it and throw it into your folder as well. Okay. Now, for all of you out there listening, what we want to do is make sure we are always coming alongside you, always trying to add value. And we've got a little special one today. We talked about make sure to like, subscribe, share these episodes. But if you just give us a review on iTunes, take a screenshot of it, send it to us. I think Corey has gotten on me before about this, but we will send you that we're good now to do this.
Yeah, no, that's
okay,
fine.
good. You guys will notice some of our end cards. Corey got on me because I was giving away the book before I should have given away the book. But you could get this book, Your Business, Your Wealth, our newest book.
That's not should. It's like we just didn't have it, But
I had one of those author copies. That's good enough for me to tell people they could order it.
Right, you could have sent it.
So if what you do is you just give us a review, take a screenshot of it, send it to info@sfgwa.com with your address and a picture of the screenshot. We will send you a copy of our latest book, Your Business, Your Wealth, and what it takes for business owners to build a balance sheet that's as strong as their business to keep them financially independent long after they no longer own that business. So with that, Corey, anything you want to tell everybody before we jump off today?
No, this is I'm excited for the upcoming episodes we've got. I'll be out on daddy duty for a few weeks, and Paul's got a great interview going back into the world of real estate. So I'm excited for y'all to, and just, sign up for the live stream, keep tabs on them, send me a note on what's going on in case I need to be worried. Like, help me out here while I'm gone. That's all.
Right on. Well, for all of you out there, everybody gets a chance to join us on these live streams. Those of you that listen offline later, we appreciate you. We love being able to contribute to you guys, and we love that you tune in. And we hope that this episode, like every episode, has been a contribution to you being able to design and build a good life.